The stock market is at a pivotal moment, with futures showing little movement as investors brace for significant inflation data. On Friday, stock futures were mostly stable, hovering around the neutral point ahead of a much-anticipated inflation report. For instance, S&P 500 futures nudged up by a mere 0.06%, while Nasdaq 100 futures dipped slightly by 0.1%. Conversely, futures linked to the Dow Jones Industrial Average saw a minor increase of 81 points, or 0.2%. Investors are closely monitoring the release of the Personal Consumption Expenditures (PCE) price index for August, which is set to be published today. This index is particularly important because it is the Federal Reserve's favored measure for gauging inflation. Economists predict that the report will indicate a rise in inflation, influencing market expectations for potential interest rate reductions. The markets are currently pricing in the likelihood of 2 quarter-point cuts in rates during the Federal Reserve's upcoming meetings, aligning with the projections set by the central bank. Yet the market's response to the inflation data could sway in either direction. Just a day earlier, strong job data was released, alongside a notable upward revision in the second quarter's gross domestic product, GDP, to 3.8%. This released information somewhat tempered optimistic feelings about the market. Investors are concerned that a decrease in jobless claims signals a stable economy, which could deter the Fed from pursuing interest rate cuts. The three main U.S. stock indexes experienced declines once more on Thursday, signaling continued anxiety among investors. In addition, the yield on 10-year Treasury bonds rose to 4.2%, reflecting investors' reaction to the recent economic data trends. Key players in the artificial intelligence sector, such as Oracle, Meta, and Tesla, also saw their stock prices retreat. Oracle, in particular, experienced a significant drop of 5.6%, hinting at rising apprehensions among some investors regarding inflated tech valuations. This sentiment raises flags about risks interconnected within the burgeoning AI landscape. So far this week, the S&P 500 has fallen nearly 0.9%, while the tech-heavy Nasdaq Composite has lost about 1.1%. The Dow Jones Industrial Average has seen a decline of 0.8%. In light of these market losses, some investors remain cautious but are also on the lookout for longer-term investment opportunities. Andrew Sliman, who leads Applied Equity Advisors at Morgan Stanley Investment Management, has expressed that he would leverage any market weakness to enhance his technology positions. The market was susceptible to a pullback, and given that tech has been a market leader, it is the most at risk, Sliman shared with CNBC. I wouldn't panic over this situation. Any decline, particularly for speculative stocks, can actually be a healthy sign for the market. Excessive speculation isn't a good long-term indicator. After the market closed, shares of Costco and Concentrix reacted significantly to their earnings reports. Costco's stock experienced a slight drop of about 0.9%, despite the warehouse giant outperforming analysts' expectations for its fiscal fourth-quarter earnings and revenues, which enjoyed double-digit growth from both membership sales and its e-commerce platform. According to the report, Costco earned $5.87 per share, with total revenues reaching $86.16 billion, compared to analyst forecasts of $5.80 per share on $86.06 billion in revenue. On the other hand, Concentrix saw its shares plummet by nearly 22% in after-hours trading. The technology and services firm fell short of earnings estimates and subsequently lowered its guidance for the upcoming periods. While Concentrix reported adjusted earnings of $2.78 per share, analysts had expected earnings of $2.87. However, the company's revenue hit $2.48 billion, which slightly exceeded the analyst consensus of $2.46 billion. Additionally, Concentrix announced an 8.2% increase in its quarterly dividend, bringing it to 36 cents per share. In the midst of these developments, Fundstrat's Tom Lee provided insights regarding market stability in relation to Federal Reserve decisions. As market investors continue to factor in 2 expected rate cuts this year, Lee shared his views with CNBC, suggesting that if the Federal Reserve only moves ahead with 1 rate cut, it doesn't necessarily spell bad news for the markets. Lee explained that a single rate cut could be interpreted positively, implying that the Fed would be making moves amidst a strong economy rather than a weakening one. His remarks follow an adjustment in market expectations upon the release of jobless claims that were fewer than anticipated. The Fed has been slow in its easing process, partly due to inflation factors, but it should have acted sooner. Caution is necessary. Just because indicators haven't manifested yet doesn't mean we should initiate a new rate hiking cycle, which is why I believe the markets will see beyond that, Lee stated.